Again, good morning, everyone, and thank you again for joining us on this beautiful day of September as we begin to again look into some of the sweet spots of the products offered by one of our carriers, that being MinnesotaLife. And today, just a couple of basic housekeeping pieces for us. If you'll make sure your phone is muted, just so any background noise doesn't happen to get its way into the system. Also, we're going to save all the questions that you may have until the very end. And a little different than usual because I have a prior commitment, I want to go over a couple of the things that I would normally save until the end. The first one being, if you're not already contracted with MinnesotaLife, please take the time to visit the Messer website and go to our Agent Resources tab and drop down into the online contracting. Open that up and do yourself a contract with the MinnesotaLife Group so you'll be prepared to sell their products. Also, this is going to be recorded, so for those of you who want to come back and revisit it within the next 48 hours, that'll also be up on the Messer website, also under the Agent Resources, under the Messer Learning Center. And always, we would like to offer to you a bonus. So in the event you're able to bring to the table a application within the next 30 days on any MinnesotaLife product, we would welcome that opportunity to work with you, get that in process, get that policy issued, and pay you an additional $100 bonus for that sale in the next 30 days. So as long as you're registered on today's webinar, you'll be eligible to receive that bonus. With all that in mind, again, my pleasure to welcome this morning Mr. Steve Summer. And Steve is the sales manager with the Independent Agency Distribution Group with MinnesotaLife, and he's got some wonderful information to share with you. Good morning, Steve.
Good morning. Good morning, everybody. Basically, what we're talking about today is really long-term care choices. When I started in the business some 27 years ago or so, basically the standalone long-term care was really the only contract that was available out there. And at the time, it really wasn't that bad of a deal. It was pretty affordable, and many of the benefits were life benefits, life payout, and so it was attractive, but still there were a lot of objections about cost. The main objections, of course, as we've all heard, who spent any time at all in the field and worked on financial planning with people, and long-term care being part of a financial plan for people who have the wherewithal that they want to protect some of their assets. Typically, what I know is, the three main objections that we have is that the first one, what if I don't use it? Then the premiums I've spent have gone for nothing. The other objection is the expense of the contract. It's very expensive. It's perceived to be expensive by the client. And then also one that's come up here recently within the last probably 4 or 5 years, and it's a direct result of what's happened in the industry, is that not only is it expensive, but the company still reserves the right to be able to raise premiums above and beyond what I originally signed up for later on in life. And that's happened to a lot of clients with the contracts from many different carriers on their long-term care, where they've had to go back in and file for new rates because of the losses that they were taking in their in-force book of long-term care policies. And so those are the main objections. Again, what if I don't use it? It's too expensive. And then not only is it too expensive, but the companies can raise the premium. And so those are sort of the couple of the things that we're going to talk about today, is what some of the new products that have come out, some new solutions that you can use with your clients, and kind of compare some of those solutions to give you an honest and upfront view of them. We also have one a solution that I'm going to share with you that uh, but again, ours may not be the right solution for everybody either. And I'm going to talk a little bit about some of the other options that are out there. But one of the things that I often like to talk about, and I mentioned earlier, I've been in the business a long time, and I like to joke about how I've been in business so long that when I started, applications for long-term care and life insurance were one page, front and back. Nowadays, you have to fill out a whole booklet full of stuff. And the good news is, with the advances in medical care, is that people are living longer, and the bad news is people are living longer when it comes to long-term care, and that's the truth. When you look at back in the day, it was like the average stay or average need for long-term care was right around 12 to 14 months. Now it's surpassed 30. So people are living longer with the advances in healthcare, and not only living longer, but the traditional long-term care nursing home type facilities have changed to where people are actually living longer and having a great quality of life. It isn't like it used to be in those facilities, and so people are actually living a very productive and good life in there and enjoying themselves. And so, but what that has done with the extended number of months that they're going to typically need care on an average, and of course, we all know that the inflation rate in the medical sector has been running unchecked for, I don't know, as long as I can remember, certainly running at 2 to 3 times higher than the average inflation rate. Even with regulations and what the government has been trying to do, whether you agree with it or not, basically one thing that Obamacare did absolutely nothing for is to rein in costs. Sort of let the wolf continue to guard the hen house, and so these doctors and these hospitals and these pharmaceutical companies can continue to raise their costs for service and goods, whatever they feel they need to, and consequently that's really greatly increased the cost of care. So when you look at that and you look at the risk that's involved, now you have and there's all kinds of studies that have been done. You have an individual's got a 40% chance that they will need care at some point in time. A couple, husband and wife couple, they've got just over a 60% chance that at some point in time in their life they're going to have a long-term care need. And so when you look at the assets and you look at how they worked hard their whole life to build a nice nest egg, how can they protect that nest egg from being depleted? And when you look at the average cost being somewhere between $6,000 to $7,000 a month, and you multiply that by 32 months, you can see how that can make a dramatic impact on your client's nest egg. And many people don't want to self-insure that risk. They'd like to try to figure out a way to transfer that risk. So basically, there are the three main products that are available out there today. You have your standalone, which is still being marketed and still being sold. That is typically a use it or lose it proposition. The client pays a premium for the insurance coverage, just like any other policy. And if they go on claim, they get their benefit. The other is another contract out there, which is sort of a hybrid or lump sum product, as I like to call it, where you can go ahead and if the client has the wherewithal, they can go ahead and write out a check for anywhere from $50,000 and up in order to get a benefit, and that benefit is guaranteed and it's contractual. So when they enter that contract, so an example would be a client spends $100,000 up front, and in exchange for that $100,000, they would get a $400,000 long-term care benefit bucket that they would be able to pull $7,000 a month out, and they may end up getting somewhere around a $225,000, $240,000 death benefit. So basically what happens is they're paying for that, so if they don't use it all for long-term care, the family's going to get some death benefit. If they don't use any of that benefit for long-term care, the family is going to get the $240,000. So they turn around and invest $100,000, and in exchange for that, they're able to leverage that money and be able to get a long-term care benefit. Like I say, and typically in that particular scenario, you're looking at about a $350,000 to $400,000 benefit amount that they can take out at $6,000 to $7,000 a month until it's gone. Whatever they don't use up in death benefit, the family would still get. So that can be very attractive for a lot of clients, and there's certainly there's a big market for it because it's certainly being sold a lot. And then you have the life insurance contracts with the long-term care riders on them, and that is what Minnesota Life has to offer. And to use that same scenario, you have a client that invests $100,000 with our contract. You'll end up having about a $350,000 death benefit. So you'd have a much higher death benefit than the other concept. But where we're different is we're only going to offer them a $350,000 long-term care bucket too. So they're not going to get the larger bucket for the long-term care that they would get with the other contract. But on the other hand, with our contract, they're going to be able to take up to $14,000 a month, rather than being limited to only like $7,000. So it's a great solution for the client that likes the flexibility of having being able to have a larger monthly withdrawal amount. And again, as the cost for care continue to rise over the years, 20 years from now, that $7,000 monthly excess benefit that they might have with the other contract may not be enough to cover, probably won't be enough to cover the cost certainly not 100% of the cost. But with the other contract, ours being able to take up to $14,000 in that particular scenario, the client would then be able to take out a lot more to help cover those costs. We also will have a higher death benefit. So that's, the client gets a little bit higher death benefit. So again, they tend to take a look at both of them. A lot of advisors, a lot of producers out there will show clients both options and let the client make the decision as to which way that they would prefer to go. And the other aspect of this is that we end up having two different types of benefits too. You have an indemnity benefit, or you have a reimbursement benefit. And many of the contracts out there that are still reimbursement, which is something where the family has to prove the cost every month to be able to get reimbursed for those costs. And so that can become a hassle, and many people don't like that. And so what's becoming more and more popular out there right now is the indemnity payout. So the client basically has to initially notify the company that they can no longer do 2 out of the daily 6 activities on their own any longer, at which time the benefit will just go ahead and get paid directly to the family. The family can decide how much or how little of the benefit amount that they want to take every month. And so it just gets sent to them automatically every month, and they can adjust that as their costs change, so that it gives them the flexibility. But they don't have to continue every month to provide copies of invoices and so on to be able to be reimbursed like they do for a reimbursement contract. So it's become a much more user-friendly type of a benefit, and more people are moving in that direction. the clients certainly like it a lot more because of the flexibility. So I guess, that's something to look at when you are presenting coverages to your clients. Would they prefer is reimbursement okay with them, or would they prefer to look at an indemnity contract? And many of the indemnity contracts, one of the other benefits to those payouts is that, again, it covers care, anything from informal all the way up to 24/7 formal care in a licensed facility. And to kind of drill down a little bit further in that, with the indemnity payout, like MinnesotaLife offers, you end up having a situation where the client could literally pay a friend or their granddaughter or somebody to come in for a few hours a day into their home to help take care of them in their own home. So informal care does not even have to be a licensed individual providing that care. They can pay somebody to come and mow their lawn because they can no longer do that. They can use the money basically for whatever they want to do, rather than having to submit a bill from a licensed care provider, whether it's in their home, coming to their home or not, or whether it's a licensed facility providing the care, which is typically the restrictions that the indemnity or the reimbursement type contracts have on them, where it has to be a licensed individual. If it's a facility that they're paying out benefits to, the person has to be in a licensed facility to be able to take advantage of that benefit. So those are some of the things to look at when you are presenting to your clients the options for long-term care. And again, to kind of get back to one of the things that I spoke about earlier, the three main objections that people have to not purchasing long-term care is, what if I don't use it? Again, the statistics are out there. 40% of individuals and 60% of couples will have a long-term care expense at some point in time in their lives. For how long, we don't know. Could be 10 years, could be a month. There's no way of knowing, obviously, how long that care is going to need. The need is going to be there, but the fact that those stats are there, and certainly a much higher percentage of people. Pretty much everybody has homeowners insurance, even if their home is paid for, and they have less than a 3% chance, I think it is, of ever filing a claim for their home burning down or whatever it is. But they wouldn't think of having a $300,000 home without a policy on it. Yet they're staring down a real possibility of a $250,000 to $300,000 long-term care expense at some point in time in their life. They actually have a 40% chance, if they're an individual, or a 60% chance if they're a couple, of having that type of an expense. When you look at the average stay now being just over 30 months, and the average expense being between $6,000 and $7,000 a month, again, it's a huge risk that people have out there. And if they do have some assets, they really should be looking at trying to protect them. And so these newer contracts, whether you go with the hybrid contracts, the lump sums, or whether you go with the life insurance contracts, you can really remove the objection of what if I don't use it? Because no matter what happens, the family is going to get a lot more money back tax-free than the client ever paid in. So that's the bottom line. No matter what happens, the client's family is going to get a lot more money back than they ever paid in because they're leveraging the policy. And so that's the next objection, again, is it's too expensive. And again, what we are looking at now with these newer contracts is, how can you say it's too expensive when you can turn $100,000 into $300,000? Guaranteed. So all of a sudden, you're looking at too expensive. It's actually an investment. You can turn money into that. And then the last one, of course, is, well, they can raise their price. And again, I know that the standalone contracts still have language in those contracts that would allow the insurance companies to raise their prices. But typically, when you look at the lump sum and the life insurance contracts with a long-term care rider, it's not going to affect the guarantees if they do end up raising the cost of the rider sum. The only thing that it would really affect would be cash value, and people typically are not structuring these contracts to build cash value when they're buying the contract to protect themselves against a long-term care loss. So, and here on the screen is a policy design choice that I'm just going to kind of show you exactly how this would work in a scenario with our contract. So here you have a client. She's 50 years old, and we're looking at a $300,000 benefit. So what the option, of course, is that she could go ahead and pay premiums or ongoing premiums for life of $3,000 a year, or she could pay $4,900 a year, $4,889, and have the contract paid up by the time she retires. So she would have a paid-up asset at that point in time. She would no longer have to pay any premiums to be able to have that asset. So, again, you're looking at total outlay of premiums for the dollar amount. So this particular contract has the accelerated death benefit, so if she becomes terminally ill, she would be able to get to the death benefit ahead of time to help for costs or for quality of life. Also, it has the death benefit guarantee on it, so no matter what happens, as long as she paid those premiums, it would, in fact, be locked in, guaranteed, if you will. And then we have the long-term care rider of 4%. Again, many life insurance contracts with a long-term care benefit or chronic illness benefit will have a 2% withdrawal rate off of the death benefit amount. That's pretty much industry-wide. MinnesotaLife is the only company out there that I'm aware of that offers a 4%. So the client has the option when they buy the contract of either choosing to buy the 2% withdrawal rate, which would give, in this particular instance, a $6,000 a month benefit, or a 4%, which in this case would provide her with a $12,000 monthly benefit amount. So here's how it looks. You have $3,000 a year ongoing life pay based on her life expectancy of 85 years old. She's going to pay substantially more money in premiums over that time than if she were to go with the short pay. But if you look at this, you look at somewhere right around $72,000 on the short pay guarantees her a $300,000 tax-free benefit. So again, it gets back to the objection. Well, it's too expensive. Long-term care is too expensive. What if I don't use it? All of these objections that typically get thrown out at us when we make the recommendation for a financial plan that they should put this into it. We end up hearing those kind of objections, but by having this in your briefcase, you can overcome all of those objections. And you take $72,000 and turn it into $300,000 tax-free over a 35-year period of time. That's a net internal rate of return of right around 5%. And so where else in today's interest rate environment can she go ahead and put $72,000 and get a guaranteed 5% net internal rate of return? Now that $300,000 can be pulled out to help pay for long-term care expenses. Whatever doesn't get used, dollar for dollar, will come off of the death benefit. And the reason I bring that up is because many other contracts are pro rata, which means if the client takes out $10,000 in a month, let's say as an example, to use for long-term care, it might end up being $12,000 or $13,000 that comes off of the death benefit because it's on a pro rata basis, the way that they figure it. With our company, it would be a dollar per dollar withdrawal. So if she took $10,000 out a month, she'd have 30 months worth of benefit. So that's basically the way that that the contracts work. Now, the other thing that I would like to bring up before I open it up and start answering any questions is that over the last few years, there's been some changes in the industry, and it used to be that in order to have a chronic illness rider, the client had to be permanent, the ailment had to be permanent, or the disability had to be permanent that was requiring the care in order for somebody to be able to file a claim. So because of that, Minnesota Life years ago, we filed a traditional long-term care rider because we wanted the people who were buying our policy to be able to access it if it was only even if it was only a temporary situation, so they'd be able to get benefit if they wanted to use it. Maybe it's a stroke situation or something like that where the person's going to improve, and maybe they'll go off of claim down the line and go back on and off. So we wanted to have that flexibility within our contract for clients. Set us apart from the competitors that were just offering chronic illness that would only pay out if it was a permanent ailment or disability. Well, I guess it was just over a year ago, within the last couple of years anyway, the compact changed the rules on that and changed it so that with a chronic illness rider, the client can still access benefit if it's not a permanent ailment or injury. So the good news is that now the chronic illness riders are that flexible. And so what we've done just recently, within the last couple of weeks, is we've rolled out our long-term care rider. It is as a chronic illness rider. So the benefits are basically the same. It's still an indemnity. You still have that flexibility of being able to get at it for informal as well as formal care. We just need to have the form filled out by the doctor proving that they can no longer do 2 out of the daily 6 activities. We're going to go ahead and send that money to them up to their maximum amount, whatever they tell us. They dictate to us how much they want to have sent out every month, and we'll just go ahead and send it to them. So everything is pretty much the same in the benefit. So there was really no extra benefit for continuing to be a long-term care rider like we've had in the past once that wording was changed. That also frees us up some on the requirements as a producer, because in order to sell a traditional long-term care contract or a long-term care rider, the producer had to have that extra training, that long-term care training. They had to have that. They had to keep it taught up. And so in order to be able to sell that, there was extra training involved. Well, with a chronic illness rider, that extra training is no longer involved. So if any of you on this WebEx have not wanted to go through that and have said, well, I still want to be able to offer these types of benefits for my client, you can now get that kind of a benefit from Minnesota Life through a chronic illness rider. Again, it's still the great rider that it was. It's just now a chronic illness it's filed as a chronic illness as opposed to a long-term care. So that's something that I definitely wanted to bring up as well. So again, I guess to recap, when you look at these types of contracts, and you look at the objections that people typically have to buying one of these contracts, what if I don't use it? Well, then your family still gets the $300,000 benefit, tax-free, in a death benefit. You're actually earning right around 5% net internal rate of return on that. Well, it's too expensive. Well, you're able to turn $72,000 into $300,000 tax-free. How is that expensive? Actually, a pretty wise investment when you look at the overall portfolio of the client. They're looking at they should have some money invested in safe investments that are earning an interest rate, and in today's interest rate environment, options are hard to find. So many advisors are actually leveraging life insurance as a way to fill that void that they can no longer get with the low interest rates of other types of investments. And so that is it's definitely overcomes that objection. How can turning 72 grand into 300 grand tax free is not necessarily should not be really considered or put on the expense side of anybody's ledger. And so that becomes a great way of overcoming that. And then lastly, the price can change. And that is correct. Our company can in fact increase what we charge for that rider, but in a situation where we have the death benefit guarantee on a policy along with the chronic illness rider, we have already contractually agreed to a premium that's being paid. So the percentage of that premium that might be allocated to cover the cost of the long-term care rider may increase, and it would have an effect on cash value down the line on the contract, but the guarantees are the same. So the actual premium dollar that the client is paying is not going to be increased. It's already locked in contractually, and so that's one way to overcome that. So all three of the main objections that I'm familiar with and received over and over again in my experience are all overcome by these types of products. And so it's a much more user-friendly option for clients moving forward. So let's take a look here and see if we have any questions here. This is I don't see any questions at this point. So I guess we can wrap this up. But please keep us in mind if you want to take a look at trying to price some of these benefits. Certainly contact the sales desk at Messer. They can run some illustrations for you and show you how your clients can leverage their money and transfer the risk from their potential out-of-pocket expense for long-term care, and be able to have the insurance company take on more of that risk for them. With that, I will end the call today. Look forward to hopefully meeting some of you next week, and have a great day.